Power doesn't announce itself. It moves quietly through systems. Welcome to Money and Power. For the last few years, the global economy has been defined by one word: delay. Delaying recession, delaying pain, delaying the mathematical reality of debt. Policymakers delayed the consequences. Markets delayed the adjustment, and you were encouraged to delay the recognition. And for a while, that strategy worked. But 2026 feels different. Not because something dramatic has to happen, not because of a single event or a sudden crash, but because systems eventually express the cost of past decisions. Quietly, mechanically, and without warning. I'm not going to give you precise predictions in this video. I'm not calling dates, prices, or market tops. Instead, I want to show you the machinery. There are 5 structural levers that will quietly shape how 2026 unfolds. They're already moving. You won't see them announced on the news. You won't hear them described this way in most commentary. But once you can identify them, a lot of the noise fades away. This video isn't about advice, it's about observation, and it starts with the map. What you're looking at on screen is the Money and Power 2026 system map. 5 levers, 1 system. These levers don't operate independently. They reinforce one another. Pressure in one area pushes stress into another. Relief in one place often creates distortion somewhere else. Over the next 10 minutes or so, we'll move through each lever, calmly one at a time, and I'll show you what movement actually looks like. Not headlines, not narratives, signals. Let's start with the one that sits underneath almost everything else. The first lever is the fiscal vice. This is the cold mathematical core of the system. Governments today aren't really choosing policy anymore. They're reacting to arithmetic. In 2024, for the first time in modern history, the United States spent more on interest payments, roughly $880 billion, than it did on national defense. By 2025, that interest bill climbed further, even before any new crisis spending. That single fact tells you almost everything you need to know. Debt servicing has grown to the point where it crowds out infrastructure, services, and political promises. At that stage, policy becomes defensive. The priority is no longer growth, it's solvency. And once a government reaches that point, liquidity stops being optional. It becomes necessary. This is why so much commentary focuses on interest rates, and why that focus often misses the real pressure. Rates are a signal to markets. Liquidity is a signal to survival. When debt loads are this large, the system cannot tolerate prolonged scarcity of money. Something has to give. And historically, what gives isn't spending, it's the currency. Slowly, indirectly, unevenly. So if you want to monitor this lever properly, don't fixate on rate cuts or hikes. Watch the plumbing. Watch the Treasury General account, where government cash actually sits. And watch repo market activity, because that's where stress shows up first when liquidity tightens. When those start behaving unusually, the fiscal vice is tightening. Once liquidity is forced into the system, it doesn't flow evenly. This brings us to the second lever, the liquidity illusion. This is where many people get confused. Markets can rise while living standards fall. Assets can inflate while households feel poorer. That's not optimism, it's direction. Liquidity doesn't spread itself across the economy, it gets channeled. Entering 2026, we're seeing a historic divergence. Large cap markets, particularly the S&P 500, have continued to perform, while small cap stocks, represented by the Russell 2000, have lagged badly. That gap hasn't been this wide since the late 1990s. This tells you exactly where liquidity is being allowed to go and where it isn't. Large institutions and system-important assets absorb it first. Small businesses and wage earners often see very little of it. The result is an illusion of health. Financial markets look resilient, headlines talk about strength, but underneath, the real economy doesn't feel it. That divergence isn't accidental, it's structural, and it's a clear signal that power is being concentrated, not distributed. Now, before we move on, a quick note. If this way of looking at things is useful, this channel is built around monitoring these systems calmly over time, not reacting to headlines. If you want to follow how these levers evolve through 2026, you'll probably want to subscribe. All right, let's move on. The third lever is the resource floor. And this one is different because this isn't ideology, it's physics. You can print money, you can expand balance sheets, you can adjust definitions, but you cannot print energy, you cannot print copper, you cannot print food. By late 2025, global copper inventories, a critical input for electrification, AI infrastructure, and modern industry, were hovering near critical lows. We had barely a week of global demand sitting in visible stockpiles. That's not a price story, that's a supply story. Years of underinvestment have constrained output, while demand has quietly continued. So while technology prices may fall and some services deflate, essentials remain stubborn. This is why inflation often feels over on paper, but not in real life. The system can suppress some prices. It cannot suppress reality. To observe this lever, you don't need complex models. Watch the gold to oil ratio, a clean signal of monetary stress versus energy cost. And watch global copper inventories. When inventories stay tight and costs remain elevated, the floor holds. And that floor limits how far inflation can truly fall. The fourth lever is the silent consolidation. This is not about conspiracy, it's about structure. Periods of stress don't decentralize systems, they concentrate them. Since 2003, the number of US commercial banks have fallen by nearly half. In 2025, we saw the return of the mega merger, as regional institutions were forced to sell to larger players under regulatory and funding pressure. Much of this happens during periods of apparent calm, not crisis. To observe this lever, ignore dramatic announcements. Watch the boring updates. Pay attention to projects like Project Agora, a wholesale payments initiative launched by the BIS, that's the Bank for International Settlements, to develop a unified ledger for institutional settlement. These are not consumer products, they are back-end plumbing. But once plumbing is installed, everything else flows through it. This is how systems harden, quietly, legally, and permanently. The final lever is the narrative gap. This is the widening distance between official data and lived experience. When systems are under pressure, perception matters. Definitions change, methodologies adjust, revisions appear after attention has moved on. The initial headline is rarely the truth. The revision usually is. In late 2024, US employment data was quietly revised down by over 800,000 jobs, long after the original figures had already been celebrated. So if you want to monitor this lever, don't react to first releases. Watch what changes 30 to 60 days later. GDP revisions, jobs data adjustments, inflation recalculations. That's where the real signal often hides. Not in what's said, but in what quietly gets corrected. These 5 levers don't predict outcomes. They explain pressure. They help you understand why certain things happen and why others don't. Throughout 2026, this channel will keep returning to this map. When a headline causes panic, we'll ask a different question. Which lever is actually moving? One quiet observation to add here. When systems behave this way, with debt pressure, liquidity distortion, resource constraints, and narrative management, certain assets don't need promotion. They simply resume their historical role. Precious metals tend to sit in that category, not because they generate income, not because they outperform everything else, but because they exist outside the system we've just mapped. And that distinction starts to matter more when pressure rises inside it. That's not a trade, it's context. Now, one final point before we close. When I first started publishing on these topics back in 2015, the view wasn't that precious metals would move suddenly or because of a single crisis. It was that they would become relevant again once long-running structural pressures reach their consequence phase. The mid-2020s through the end of this decade always looked like that window. Not because of a prediction, but because that's how debt accumulation, liquidity distortion, and resource constraints tend to work their way through a system. What matters now isn't whether that view proves perfectly timed. It's understanding why those pressures are now visible and how they connect to everything we've discussed in this map. Because power rarely announces itself. It expresses itself through systems. If you want calm monitoring rather than noise, frameworks rather than forecasts, that's what Money and Power is here for. This isn't about fear, it's about clarity. Thank you for watching, and if you wish to, please subscribe.